Hello everybody, Senior Analyst Kyle Custer here, and I'd like to talk about a few things that have been released in the last week, one of which is the semi-annual report from the ISM about looking forward into 2017, and we'll talk about the CME Group's current projection for Fed futures and what we're looking forward to with the FOMC meeting this week. So here's the CME Group's table, and I think we're all pretty sure, and the Fed futures are saying that for the December meeting we're looking at a 95-96% chance of a rate hike. So there's always that uncertainty, but we're pretty sure there's going to be a rate hike this week. However, what are the futures markets saying for 2017? So let's look at June, 6 months from now, and we're looking at actually. There's still around a 40% chance that with the rate hike this week, the potential rate hike, I should say, we will remain at that level until June. However, there is around a 50 to 60% chance that we will be above the 50 to 75 basis point range for the Fed funds rate. So 43% likelihood of a 75 to 100 basis point level in June. But what about all the way to next year? So we're looking at November, and this is what I find interesting is we're still at that 40% level of 75 to 100 basis points. So what we're seeing in the CME group here is that we're really not anticipating in the market much more than one rate hike, maybe two rate hikes in 2017. The ISM Semiannual report is they use their survey and they ask the survey members for manufacturing and non-manufacturing whether or not they feel 2017 is going to be an improvement over the past year, and they quantify it. And it's a great way to look forward and get an idea of what actual business owners are saying or supply management teams are saying about future growth. So when we look at manufacturing, we have an operating rate of an 81%. So that's like a capacity utilization on a microeconomic scale. They anticipate that to improve over the next year, but what we're going to see is it's going to improve because they're going to be reducing their investment into their business. So they're going to be pushing the workers a little more, and they're not going to be expanding their infrastructure as much. And that's here with the CapEx. CapEx in 2016 was up from the previous year 7.3% for the manufacturing sector. So they're throwing in money, revitalizing their fixed assets, probably prepping up for 2017. It sounds like business owners and supply chain management executives are really thinking 2017 is going to be a great year. And then you look at the 2017 CapEx expenditures, they only plan to do about an increase of 0.2%. Inflation is indicated in this report as well, and the survey is reporting that they're expecting around a 1.3% increase in prices paid. This gives you a good idea of the input prices. They expect to increase around 1.3%. That's compared to a decrease of 0.4% in 2016. Labor costs are expected to increase 2.5%. That's pretty much on par with a little above probably cost of living. It's above inflation, so that's a good sign to see labor costs increasing a little more than inflation. Here's the big one now. The revenues expected for the manufacturing sector are expected to increase 4.6%. So you have your prices paid and your labor costs are not increasing at the pace of revenues, so there's going to be greater profits this year. This is compared to a 0.9% increase in revenues over 2016. So let's talk about non-manufacturing, much larger segment of the GDP. And the operating rate is now going to be, or the past year was an 85.2%, and they anticipate that to increase. Now again, that's back in the CapEx expenditures. They're not going to, over the past year they had spent increased expenditures 10.2%. That that is to be anticipated for 2017 actually to drop. So they're going to really, they retooled up in 2016, and they're going to be utilizing that capacity and pushing it more. Inflation is indicated here as well, of around 1.1% for prices paid, compared to this past year of actually a decrease of 0.6%. And the survey also asks these participants why they think the prices have changed or why they think they will change. A lot of that's tied to oil prices. Labor costs on par with manufacturing, they increased 2.5%. And again, we look at revenues. Revenues are expected to increase 4.1% for 2017. So again, great signs. ISM report is coming out. It seems to me to be a very positive report. The ISM indicator itself is well above the 50 level. We haven't seen it below that for a while, so that's indicating an expansion period. So a couple key indicators that are indicating what's going to be happening in the future of 2017. And of course, next week we will cover the FOMC meeting and the comments that have been made by Janet Yellen. Thank you very much, and have a great week.